Good morning and welcome to the Bernkopf Goodman Shapiro webinar, Now is the Time, Estate Planning During the Pandemic. Thank you to those who sent questions ahead of time. We will also have a question and answer session after the presentation. Please use the Q&A section to submit your questions, and our speakers will do their best to answer as many of those questions as possible. Quick reminder, the purpose of this presentation is for information only. Communication with any member in this forum does not establish a client relationship. Any information provided by our panelists is not legal, tax, or financial advice. Confidential or time-sensitive information should not be discussed on this forum. Speaking today, we have Stephen Bonder, a partner and industry leader of the Blum Shapiro Private Client and Family Office Group. Stephen focuses on advising privately held companies and high net worth families, business planning and operations, as well as accounting, auditing, and tax planning and compliance. Juliette Galicia is a principal of the law firm of Lourie Cutler in Boston. The focus of her practice are taxation, estate planning, business planning, and representation of individuals and business taxpayers in tax controversies before the Internal Revenue Service and the Massachusetts Department of Revenue. In the estate planning arena, Juliette works with her clients and their advisors to design and implement tax-efficient estate plans that meet her clients' objectives, including philanthropic goals. Jonathan Korb serves as General Counsel and Managing Director of Tax Services at Loring Wolcott Coolidge. He oversees the firm's legal, tax, and regulatory affairs. And Eric Allon is a partner at Bernkopf Goodman and has been recognized as a thought leader in real estate, has written extensively, and has been a speaker and moderator on numerous panels, including being a TED Talk style speaker at the Coronet Global Summit at the Heinz Auditorium. Eric was recognized earlier this year as a top influencer by the commercial real estate publication Globe Street. Eric, why don't you start?
Thank you, Jeanette, and thank all of you for attending this webinar today. The pandemic has been a tragedy for many and created uncertainty for all of us. Our clients during these times have turned to us for estate planning advice, either regarding their existing estate or concerning creating an estate or to implement their estate plan. When they do approach us, we form a team of experienced people to try to address those estate concerns. And for complex estates that are large, we particularly rely upon people such as Juliette, Stephen, and Jonathan. That team helps to implement the plan. And during the pandemic now, particularly as a result of the economic crisis that it has created, we've realized that there are unique opportunities for estate planning, both philanthropic interests of those who are planning their estate, as well as to transfer wealth to the next generation and beyond. Stephen, I want to start with you. Give us some idea of what are the unique opportunities related to these times.
So good morning, Eric, Jonathan, and Juliette. It's good to be here with you today. So in periods of uncertainty and disruption, there are ways to prepare for various outcomes and take advantage of opportunities, certainly. And as we look around at today's income and estate planning landscape, we've noticed some very interesting changes. But let's take these, for example. Very low interest rates as compared to historical rates. In fact, Jerome Powell, chair of the Fed, announced 2 weeks ago that the Fed plans to keep interest rates low for at least 3 more years. There's the potential for reduced valuations of real estate and business ventures. We have seen changes in cap rates and free cash flow resulting from today's changing global business environment. And while not making predictions, there are significant differences between the Republican and Democrat proposed tax policies. There could be limitations or eliminations of current common estate planning techniques. For example, should we be prepared for an earlier reduction of the lifetime exemption amount, the elimination of step-up and basis at death, or an increased tax rates for corporations and individuals? Now, let's keep in mind that there's no guarantee what is discussed now will be enacted, Potential tax changes are important to consider, but they should not dictate a family's plan. And lastly, the current tax law permits a very favorable, almost $12 million per person personal exemption for gift and generation skipping transfer tax purposes. So, Juliette, given low interest rates, potential for low valuations, and expiring high lifetime exemptions, what are some of the estate planning tactics that folks could consider?
Morning, everybody. You're right. If there's any good news amidst all this uncertainty and anxiety created by COVID, is that the time right now presents many very attractive opportunities to take advantage of the factors that you mentioned, Stephen, the low interest rates, the depressed asset values, and a very high exemption amount, which is currently 11.5 per person. And to put it into perspective, let me just briefly talk about how the estate tax works. So every person has an exemption amount, which, as you mentioned, is extremely high right now compared to prior years. And the way the estate tax works is that you have this amount, and we're talking about federal right now, that is exempt from taxes. So if you're below the exemption, your estate is not subject to estate taxes at all. But if you're above the exemption, then even then, only the amount over the exemption is subject to estate taxes. And the current rate right now is 40%. And so when that exemption amount was increased to the current level, the way that the law was drafted is that it's scheduled to sunset. And what that means is that it's going to revert back to 1/2. So right now we're in a situation where the exemption could be disappearing, and you could take advantage of it now, because there's two ways to use your exemption, and one is by lifetime gifting and the other one is upon your death. And we obviously are not planning for death. We're planning right now for you to be able to use your exemption before it goes away.
But we do know, Juliette, that we're all going to die. So that with death being a certainty, then the question is, implementation now may have some significant advantages if there's going to be changes in the law that may come. And when it's 11 point, what is the actual exemption per individual? 11.54?
5.8.
5.8. Then for a married couple, it's 23 and change, and not small change. But it used to be, what was it, Jonathan? 684,000?
2,685,000 was the exemption. And in the UK right now, it's £325,000. So there's some precedent for lower exemptions. And when we say there's some immediacy, there is some concern with the practitioners' advisors that if there's an administrative change at the end of the year, at 2021, January 1, in fact, that 11.5 million could be substantially lower. And if you harken back to the earlier Obama administrative tax policy changes from the Green Book in 2015, there's a movement afoot to bring it back to 3.5 million with a $1 million gift exemption during life. And so there's substantial changes in addition to the basis step-up elimination that Stephen was talking about.
So Eric, I would say we all know we are going to die, but we don't know when we're going to die. And the way the law is scheduled to sunset is if you die in 2026, assuming nothing else happens in between, after the election, anything else could, the laws could change even more. But we can't plan for a death before 2026. What we're trying to do is you have this exemption that's available to you now if you haven't used it already, and you can plan to make gifts in order to minimize the transfer tax cost of passing your wealth to your family. And the point being is we're trying to have you maximize the wealth that you transfer to your loved ones instead of, paying taxes.
Right.
Julia, I hear a lot of acronyms out in the world in estate planning: CUPERT, SLATs, GRATs, IDGITs, all kinds of different types of trusts and vehicles. Could you, for example, what's a SLAT? What is something like that?
Sure.
And how is that used in estate planning?
Sure. So I think the reason we lawyers like to refer to acronyms is because most of these vehicles, they're mouthfuls. So what a SLAT is a spousal lifetime access trust. And what that does, and the reason it's beneficial now, is that one way to use your exemption. So let me back up. The exemption, your exemption, the 11.5 $5 million now is a unified exemption. So either you use it during your life or at death. So what you can do now is fund an irrevocable life insurance, an irrevocable trust, and use your exemption for that gift. But what you normally, when you make a gift, you can't retain any rights to it or enjoyment, or it's going to be brought back into your estate. So what a SLAT does is that it allows you to have your spouse be a beneficiary of that trust, and through your spouse, you indirectly can derive enjoyment from the property in the trust. Now, the SLAT works as long as your spouse is alive and you're married to that person, because your access to the trust is really through that spouse. But it's beneficial now because you could fund it with depressed asset values, or if you have exemption available, you can use that before you lose it, in 2026 or even before.
Yeah, I've heard this old saying that great estate planning is very bad divorce planning. So I guess things like that need to be taken into consideration, but that kind of...
The question is, you could define your spouse as your current spouse or your future spouse, and that wouldn't be good for your current spouse.
Jonathan, go on, Stephen.
So we talked a bit about using this lifetime exemption in gifting of assets. What type of assets are good to gift, and what type of assets are not good to gift?
That's a good question, and I think we should step back for a moment. When you are transferring and making gifts, you're transferring your wealth, and so first of all, you have to make sure that you're comfortable transferring that wealth. You're considering your lifestyle, and are you retaining sufficient assets for your support? But also in terms of gifting and transferring, you have to consider the income tax consequences as well. Under the current estate scheme, assets that are inherited acquire what's called a step-up in basis. And what that means is that the inherited assets, when they are sold, will not result in significant or even any taxes. But when you gift property, then the gifted property also acquires it's called carryover basis. So when gifted property is sold, you have the potential of an income tax liability. So you have to consider, what assets you're gifting, and consider that against the income tax cost. So it's a trade-off. And as long as, we're assuming that step up in basis will still remain part of the estate tax, strategy, then you have to consider what assets are appropriate to gift. Or there may be also, for example, partners in real estate. Many of these partnerships have partners with negative capital accounts, and where normally a transfer of a partnership interest is not taxable, if you have a negative capital account or if liabilities are shifting, then you have to consider what the income tax consequences could be of that transfer. Whereas if a negative capital account is retained until death, that obtains a step up in basis, and basically it goes away. And there's other issues regarding whether you can even transfer the interest. There may be restrictions on transfer, or the partner may be a guarantor of a loan, at the entity level. So you can't just, you have to consider every situation is very specific, and you have to take into account the income tax, the estate tax savings for each.
And there's a couple of points I wanted to make, then I want to turn to Jonathan. One is that when a client comes in the door, you got to know the assets and liabilities, and you got to dig down deep enough to know, for example, what, as you said, what are the entity documents? What are the restrictions on transfer there? And you have to address it, particularly if they're partners or different members in an LLC. In addition, you need to look at the loan documents and see if there's restrictions on transfers there of beneficial interest, as well as if there's guarantees and if there's a death on guarantee. We are dealing with a large estate now that Stephen and Jonathan are involved with that have guarantees and death being a default and restrictions on transfers. But at the same time, Jonathan, I wanted to turn to you, and you can answer any other question you want, but one that I do want you to address is many of our clients, as you know, want to retain control. They've built their wealth and they want to retain control. And although the SLAT may be a method that one might use, if they want to retain direct control, but still do a transfer that's effective now and not wait till their death. Well, give me an idea of what one might do and what we're doing.
Well, I think I'd start with the point of back to echoing what Juliette was mentioning earlier. It's hard to have a completed gift when you retain dominion and control. And given the fact that significant wealth in families, it may not be the best time to make large distributions or gifts to younger generations before they're established in their career, before they're married. Maybe there are some other maturity issues that maybe militate against making current gifts. One should never forget the utilization, the efficacy of trust. They've been around since Roman and Egyptian times, and it's for a reason. They're quite flexible, and think of them more as a conveyance over time. And while you can't have control being the sole trustee, certainly settlors have the ability to participate in decision-making at the trust level with regards to investments, lending, things such as that. And of course, they can always speak in the ear of their co-trustees with regards to distributions, but typically there needs to be some independent trustee involved. And that's what we were talking about earlier, that sometimes for larger families, it even makes sense to set up their own trust structures in conjunction with a trust company to manage the family affairs. For smaller ones, we favor, like the Loring Wolcott model, a multifamily office approach, where you have family members serving along with individual co-trustees so they have a seat at the table. So what I can guarantee, there are numerous structures out there where you can have a seat at the table and then be involved in investment decisions, being able to borrow against the property and the trust, being able to transfer assets back and forth between the trust without income tax consequences if properly structured. So you can have a modicum of control, but not complete control. And what's clear is, though, I think I'd like to echo what Stephen mentioned earlier about the fact of divorce planning and estate planning don't often go together. Typically, before you start moving assets amongst spouses, you do want to understand the relationship, also the relationships with the children, as well as if former marriages exist. And one very popular device for blended families or marriages is the Q-tip, which is the Qualified Terminable Interest Property Trust, which is a form of a marital trust, which you're able to fund either at death or during life, give your surviving spouse an income interest, or your current spouse an income interest if you're both alive, and then dictate on her or his passing where the assets will transfer. And I think that's extremely useful because prior to that, the old rule was you had to give all the assets outright to spouses in order to equalize estates. So with portability and some other things in the exemption amounts, it really is simpler to fund trust currently in the current estate planning environment. And I'd end with this point. I think categorically up to your existing exemption amount, once you decide how much money is enough, it almost always makes sense to gift during life than to wait till you're passing to transfer the assets. The only issue that requires a little bit of analytics is the carryover basis issue or the step-up basis issue. And for real estate folks who have the 1031 capability, which is the ability to do transfers without recognition of income with regards to estate property swap, to real estate swaps, the basis step-up is less important. And so I think my mantra is gift early and gift often. It's better to gift while you're living.
So
There's a balancing, and Stephen, jump in. Yeah, go on.
Just to move to another interesting environmental issue here is the low interest rate that currently are in play. Jonathan or Juliette, do you want to comment on what former techniques are now rendered less useful because of low interest rates, and which techniques are now much more interesting because of the lower interest rates? For example, intra-family loans, or how do you help the next generation acquire a personal residence, or things like that. So what had been in vogue and now no longer is, and what things really are much more powerful now because of these low interest rates?
So there's the low interest rate, which is the applicable federal rate that is used for tax purposes to determine whether a loan, an intrafamily loan, provides for adequate interest, and if it doesn't, then it's considered a gift. So one, technique, as you mentioned, to help your children is to make a low interest. Currently, the rate for a long-term loan, in October, it just came out, it's 1.12% for a long-term loan. So what that allows is your child, for example, to use the loan proceeds and invest in the market or invest in a business. And as long as they're earning more than the interest rate, then that's wealth that you're able to transfer to your children. I think the other concept you're talking about is the 75/20 rate. And that's the rate that is used by the IRS for purposes of calculating the gift of various techniques. So for example, one technique that is popular now and that works quite well with the 75/20 rate being so low, and that rate is 0.4% right now, and I think it stayed the same for October, is a grantor retained annuity trust, and that's a GRAT. And what that does is actually allows you to retain transfer property to a trust, and you retain an annuity coming back to you, and whatever's left over in the trust, that's the gift that you're able to transfer to your loved ones. And with the 75/20 rate being so low, it actually decreases the amount of the transfer. And the goal there is that the 75/20 rate is the threshold rate, which being so low, that's anything that you earn, anything that's left in the trust beyond earning capacity of 0.4%, that's money that you can transfer tax-free. And these GRATs are usually structured as, they're called zero-out GRATs, which means that the way you structure the payments coming back to you is structured so that there's no taxable gift. So there's no tax up front for the transfer to the transfer to the GRAT.
So the
just wanted to add one thing, that some folks have been extremely successful in transferring large wealth with regards to GRATs. The Walton family has done a significant transfers of utilizing GRATs and freezing estate values, as has Bill Gates, and more recently Adelson transferring the sands. So a lot of folks have transferred significant wealth utilizing GRATs for freezing techniques. And when you say the 0.4%, that's the discount rate for valuation. And echoing what Juliette said, is everything that occurs above that 0.4% is transfer tax-free. And what I'd also add is the historical rates of return on equities is approaching 7 or 8, and other properties it's higher. So real estate earning higher or equities earning higher than 7, you're only trying to outperform the hurdle rate of 0.4% before 400 basis before tax. Yeah.
Yeah. So the benefit is that the appreciation is removed from the donor's estate.
Right. What's left of the trust, left of the annuity payment, basically that all of that is removed from the donor's estate and transfers tax-free. And the downside of a GRAT is that the grantor needs to outlive the term of the retained interest in order to be successful. But even then, because there's no gift tax cost from setting it up in the first place, there's really nothing to lose by setting one up. And one thing to consider is normally the strategy with these GRATs is to set up short-term GRATs, and short-term rolling GRATs, so that the grantor will outlive the term. But now with 75/20 rate being so low, it may make sense to do a longer-term GRAT to lock in the low 75/20 rate.
Jonathan, I wanted to turn to Jonathan 1 second. And Jonathan, Stephen mentioned earlier the idea of depressed valuations, particularly on real estate. And I wanted you to mention in relation to that, on those depressed valuations, how it can be used now currently to benefit one's estate planning, particularly in relation to the exclusion that Juliette spoke about.
Yeah. Well, I also want to come back and circle back to answer Stephen's question about what structures interest rate sensitive trusts don't work well in this environment, but answering your question first on the real estate, I think there's some concerns that given the fact that in 2015 there was a movement afoot for regulatory changes in the valuation of closely held businesses, such that there would no longer be allowed minority interest or non-publicly traded discounts for closely held businesses. And if properly structured and valued, those discounts could approach 35 to 45%. And at a 50% estate tax bracket, combined federal and state, that could yield significant savings. And the IRS regulatory body was starting to say that those discounts amongst family members were illusory and weren't actually appropriate. And my experience, as I think is yours as well, has been family members owning businesses should get a larger discount, not a smaller discount. And that once the patriarch or matriarch leaves this earth, oftentimes the children work out childhood issues or why mother or father didn't like me best or liked you better through their attorneys. And that can significant costs. So I think there's some value to some legitimacy to the discount, one. And two, there's some impending changes that could happen if there's a Biden administration going forward, so that I think gifting makes more sense, and also gifting those unusual assets that may allow you to take that discount on top of the valuation and getting a 30 or 40% discount. And I point out that that may be disappearing in the not too distant future. So I think that's just one of the other reasons that doing the estate planning sooner rather than later is quite important right now. But I think answering to Stephen's question is, years ago, I spent a fair amount of my time setting up qualified personal residence trusts for people's vacation homes. I can tell you I haven't set one of those up in probably a decade since interest rates went way down, because the higher the interest rate, the lower the value of the residue is. So the QPERTs work quite well in interest rates above 5%. Right now, in interest rates that are non-existent, they're basically not very helpful at all, and they said we don't do them anymore. Charitable lead trusts are quite popular in this interest rate environment, where you actually have an amount of the income going to the charity and the remainder goes to the family members. It's not necessarily good for generation skipping transfers, but it's quite useful to transfer property to your children. And it also allows them to effectively utilize funds outside of their income for charitable deduction purposes. And so you're able to fine tune your personal deductions and also get charitable deductions at the trust level. And I've seen some folks use them as a way to incrementally step up the basis of appreciated stock. That's a little complicated for this one, but there are some uses for CLTs. And one thing we don't see right now, absent significant charitable inclinations or the desire to create almost like an installment sale, is a charitable remainder trust. They again are interest rate sensitive, and the charitable deduction for funding goes way down when interest rates are low. So that's another one I haven't set up in a while. Steve, has that been your experience too?
I agree with your analysis. Very well said. Thank you.
Stephen, I interrupted you. You had a question back to Juliette.
I must admit that I think it's been answered at this point. Thank you. I do have one question I'd like to throw out to the panel. How does estate planning and business exit and succession planning work together? How should people think about those in terms of how they dovetail together, and a plan over the course of time to implement a transfer from generation one to generation two of that family business? How does one model that out? One think about it.
Well, I would start by saying, Stephen, that in the large estate that we're dealing with, we want the death of the key player here to be as a non-event for the business. That is, he wants the business to continue. He wants it to continue, and there is a family member involved that makes that possible. So that as much planning as you can do in advance is critical to how the business proceeds. And I think that when Jonathan said to me earlier in the week that documentation is just the beginning, implementation is the key. And I think when one looks at estate planning, it's not a static process. And just as we're revisiting estates now to see what the what can be done during the pandemic, I think it's critical to think in relation to a business, what are your goals? If you have no one to succeed you, it may be a different goal than if you have someone. And so I think it is important not only to know the assets and liabilities, but know the intention of the key player who may be passing away and controls the assets. Jonathan and Juliette, any thoughts on Stephen's question?
No, I agree, and I think the point you make is a very good one. Yes, estate planning and business planning are intertwined, but they're not exactly the same. And as you said, Eric, I mean, the business succession planning really looks at what does the, what is happening with the business and how do you transition that? Is it being transitioned to the next generation, or do you have partners and co-owners, and how will that business stay within the existing ownership structure? So it starts with a buy-sell agreement, but there's a lot of questions and decisions that you need to decide on and consider in starting to draft a buy-sell agreement to implement the transition of the business to the next generation. And from an estate planning perspective, that business may be the single most valuable asset, including the underlying real estate. So there's a lot of questions about how will that impact your estate planning and the estate tax exposure as a result of that large asset. And oftentimes there may be only one child that's involved in the business. So how do you take into account the fact that one child may be active in the business and the other children may not be? And, so it goes to control and value. And there's a lot of issues to consider family dynamics, as you mentioned. So it's an intertwined process, but they are two separate,
Yeah, so let's flesh that out a little bit more, because I think I run into this quite frequently where let's say there are 3 siblings and one is active and 2 are not. I'd be curious, Jonathan and Eric and Juliette, what's your experience been with, does the generation 1 leave the business equally to the 3 siblings, or do they substitute assets instead, so that the one person who is in the business gets 100% of it and the other siblings get some kind of substitute? Well, what do you recommend, and what have you seen people considering?
Well,
I'd say I've seen it both ways, and I also think it's critically important to understand how the children or siblings are functioning together as a family unit. And I think clearly I'd back up for 1 second and say it's critically important to have a team approach to the estate planning. And when there's a corporate asset, closely held business asset, involving the corporate attorney is critically important, as well as the tax folks, in getting an effective plan. I think the initial question is are you going to continue the business or not? And if you're not going to continue the business, or you're going to sell the real estate, that's a whole different estate plan and different named players in the roles of executors and trustees. I think the harder question is when you're going to go on in the business, and how do you think of as a management structure? And when you have one person working, I've seen both models, one of which is all the non-business assets go to the other family members. There also may be insurance to give a payoff for equalization to the non-business family member that's going to be excluded, if you will, from the family enterprise. Or there's that buy-sell agreement with a payout over some period of time. But clearly that's the one that's going to lead to potential disagreement on the management. And so I think a couple things are critically important. One is, once the plan's adopted or defined and decided upon, that the father or mother get together with the children and explain it to them and sort out the issues before World War III starts. I think that's a good one to see if there's buy-in. And I think by doing the conveyancing over time, as well as involving them in estate planning, you can see how the children are going to react. And I think it's important to have the children being able to collectively remove and replace trustees. But that would probably be my management approach if I felt there was some dissension, is to require some type of professional management with family members able to vote groupings in and out of the management role. I think it's highly unusual to see one family member run the business, the other folks not be included, and then not get a proportional or disproportional share of the liquid wealth. That's what I do typically see.
And I would say, just add to that, Jonathan and I have experienced in numerous instances where if one avoids addressing this issue up front, one will unfortunately pay through money that would otherwise go to the next generation in litigation expenses. And that's been a tragic result in many instances. The other thing is that there's never a time when you're too young to plan for your estate. Unfortunately, we've had people pass away with significant assets when they had not planned for their estate, and that leads to great disharmony. Finally, I would just add to what Jonathan and Juliette said in relation to the personal representative that used to be called the executor, and who's ever, the trustee of the estate, we do need some protections for them so that except for gross negligence or willful misconduct, they have some freedom to settle the estate, and you have either arbitration provisions or other provisions to avoid expenses being wasted on attorneys. Jonathan again said to me a statement. You can share it, Jonathan. Yeah, go on.
Yeah. Well, I just want to back up the one thing to what Stephen was asking about earlier. The similar about having them named as an executor, personal representative, or family member as a trustee creates something of a lightning rod in some families. Similarly, it would create the same thing in a business. So I think they're the same dynamic issues you need to be looking at. And that's what leads to sometimes having independent trustees that can be removed and replaced much more. But clearly giving the executor, personal representative authority and the mandate to settle the affairs without being constantly second-guessed considerably reduces the risk exposure for litigation. And I have a favorite Mark Twain saying that is, the town that can't support one lawyer can always support two. And so the idea isn't not for your wealth to be dissipated in legal fees. It's actually to make sure, at least I don't think the dean would say this, but you'd like to make sure their death is pretty much a non-event to everybody else. Obviously, the grieving, I don't mean to make light of that. But I think on the business side, you're going to pass away at some time. Company's coming. You should clean up your financial house and not leave a mess for children, executors, lawyers, and others to sort out. So the more you're involved with cleaning things up in anticipation of the death, frankly, the better off for larger estates you are.
And I would add to that one of the advantages of doing estate planning in the first place, or revisiting it, is that you get to do house cleaning in general in relation to your business affairs. And I think it's critically important to do it. And also what Stephen and Juliette were talking about is unintended consequences or surprise taxation that you were mentioning earlier is something that gets solved by working as a team as we do. You set up certain types of trust instruments, but when you review it with the accountants such as Stephen Bonder, you realize there may be problems created by what you're doing. And, this is, the process, as I say, is a continuum. But I also think it's important to keep in mind basics like what I would say continuing estate planning, such as the ability to transfer $15,000 each year, and two of you can transfer 30. Can somebody speak to those types of things one should consider as one is dealing with an estate, such as retirement plans and other issues, schooling, medical expenses, things like that. Jonathan?
I was covered a lot, but I think it's a number of it. Obviously, you have the per donee annual gift tax exclusion. That's that $15,000 per person you're talking about, or $30,000 if you gift split and you're married. I think the other one is the educational expenses, where grandparents or parents paying the tuition for their children is not taxable. I think the other one is the medical expense exception. You can pay another person's medical expenses without gift tax implications. But I think you actually lead to an excellent point. It's not necessarily one thing, it's multiple things that lead to really effective wealth transfer. And it's making your family gifts in early January. It's making your charitable gifts at the end of the year. It's making sure you avail yourself of the annual gift exclusions. It's using the $11.5 million exemption. It's creating what we call grantor trusts, where the settlor pays the income taxes so that the family members get an income tax-free income stream, which is levers the gift by 30 to 40% in some instances. I think it's that, it's being the family lender. It's just a number of things that in aggregate create significant wealth transfers. The other thing is, you know, I hear so many times, I don't have children or grandchildren, I'm not ready to fund a trust or make a gift. And what I found is people have been quite successful in our office of making gifts before the children or grandchildren were born in trust. And now we have 30, 40, $50 million trusts that go out to generations later that actually weren't taxed in the estates. So there's significant opportunity with forethought, and don't think 10 or 20 years, think generations. And that's how you stay wealthy. And I'd say this, I have no idea how to make you wealthy. And if I did, I probably wouldn't tell you. I do know how to keep you wealthy. And that's a different discipline. And that's exactly what it is. It's discipline, it's thoughtfulness, it's having the right people. It's long-term investing, asset allocation, keeping fees down, having insurance for liquidity. And it really comes back to it takes a village, if you will, to settle the estate. And I think that's why I was delighted to join this group, is we work with the real estate attorney, we work with the accountant, we work with the drafting attorney. And once you finish the instrument and draft the documents, that's just the beginning. That's not the ending, as we said earlier. And I think that's where the administration comes in. And there's a lot of opportunities to lend between trusts, limit valuations, and do transfers at favorable rates. And so I just think it's a multifaceted approach.
I would ask, you know, particularly as the pandemic has been so devastating to nonprofit institutions, I would just add that many of our clients want to have a legacy that goes beyond transfers of wealth to family members, but they have philanthropic concerns, particularly now with the several institutions at risk of failing in the nonprofit world. So I think that, you know, there are opportunities to make charitable contributions that have great value.
A significant opportunity and need. And the other thing I'd make is back to when we were talking about awkward assets. Retirement assets are a particular asset that doesn't get the stepped up at basis at death. And so the recipients of distributions from your retirement account after death are actually taxed on that in addition to the federal and state estate tax. So you're talking getting near 60 to 70% potentially in combined taxes on retirement assets. That's a perfect asset to leave to charity. There's no income taxes when it's received by the charity. There's no estate taxes when it's given to the charity. And the other thing I'd like to make is now during the pandemic, it's absolutely a time when charities need money. And the idea of significant gifts being made at death, to me, is an anathema, because you get an income tax deduction for charitable contributions. And so if you're long in years or you're thinking of making a substantial charitable gift, making it during life gives you what we call in the trade a double deduction. It gives you an income deduction plus an estate tax equivalent deduction because it's excludable from your estate and it qualifies for the gift tax child deduction. The long and the short of it is you get both an estate tax deduction and an income tax deduction. And for substantial gifts later in life, you can pretty much eliminate a substantial portion of your income taxes by making those gifts during life. Plus, you get the opportunity to see how the charities spending your funds. And if you'd wise and involve Juliette in the gift document, you end up making sure that you have some opportunities to enforce your gifts down the road should the charity not act in the way you were thinking of.
One thing that we're coming near about 15 minutes left, and I would like to, at this point, have some, you know, what are parting words that you would want to make, each of you, in relation to estate planning. Stephen, we started with you before, and I would like to start at the very beginning of this webinar, and I'd like to start with you again. What are your thoughts as we end this webinar of what are your parting suggestions?
So I get the sense that during these challenging times, people can think about their personal goals and legacy, as well as spend time with their families to discuss these matters. The creation of the estate plan documents is not the goal itself, but rather the estate plan is the tool the strategy that achieves your personal goals. And I'd like to add, to properly implement many of the strategies we discussed today, several steps and extended time may be required. With careful guidance from your financial, tax, legal, and valuation professionals, these strategies can be accomplished. Waiting to the last minute is not an advisable strategy.
Juliette, what are your thoughts?
I think I would echo what Stephen is saying, and I just wanted to point out as well that we talked about a few strategies that are, that make sense and work well in this current environment, but there's others that we didn't talk about, for example, installment sales and things of that nature that can take advantage of the low AFR. But to echo Stephen's point is that things take time, decisions take a long time to make. You have to consider family dynamics, decisions about what assets you have, what assets are adequate. You may need to obtain appraisals. So you not only do you need to decide what you want to do with your estate plan, but you also need to draft it and you need to implement it. So you need, all those things take time. And we're already in September. This year has actually, in many ways, stood still, and in other ways has seemed to fast forwarded, and we're already in September. So things take time, and in order to take advantage of some of these opportunities, really the message is sooner rather than later. And we know the exemption is going away, and it may go away even sooner than 2026.
And Jonathan?
Yeah, and I'd just follow up with that. I'd say run, not walk to your appraiser if you're thinking about doing any gifting near the end of the year, because I can tell you they're already queuing up. And we've been at our firm sending clients there for months now to get their unusual assets appraised. And I think the other thing I'd like to say is that don't discount the value of trusts for non-tax reasons. And I think we talk about the tax savings, tax efficiency, and we haven't chatted about for a moment the trusts actually if properly drafted, create a creditor-protected pool of assets available to your family members that isn't subject to bankruptcy cases. It isn't subject to creditor attachment. If properly drafted, it's divorce protected. And so you're able to keep the inherited wealth in family lines, if that's your inclination. Or you might like the in-law better in the divorce, and you might want to include them. So you have the flexibility as well. And what I'd say is trusts are extremely flexible. They've been around for thousands of years for a reason. And I think part of the reason is people, when they're gone, would like to have that legacy, but also understand that there's a protection element, because wealth is very difficult to accumulate, but extremely easy to dissipate. And I think that's what I've learned by the multi-generationally family offices, that they view themselves more of stewards of fortunes than necessarily creators or consumers of the family wealth.
And my parting thought would be that each estate is different. We have to listen to our clients. And in addition, we need to be humble as attorneys and realize that we do need a team with complex estates to help us get to the right results for our clients. I think Stephen's point, I would reiterate, the goals of our clients are what's critically important to implement. And we've not touched enough on the idea of the implementation and what model's best, nor many other thoughts in relation to estate planning. But I think if you form the right team, you'll get to the right result. So I'm going to turn it back to Jeanette now. And Jeanette, there are some questions that have come up, I believe, during this meeting, and please share with us what those are.
Sure, and just a reminder, if you do have a question, you can use the Q&A button on your screen to submit that question. And one additional reminder is that we will not be providing any legal, financial, or tax advice. So please keep your questions general in nature. First question is, how should you plan if you have assets both in the US and overseas?
Any takers on that one?
Sure, I'll take that one. It's just going to happen to be involved in a foreign estate right now. And I think I'd say this. We try very hard as trust and estate planning attorneys to avoid probate. And that's U.S. probate, which is time-consuming, expensive, and delays the implementation of your plan. It's exponentially more complicated to have probate in a foreign country, but have what we call ancillary, where you actually need to have probate in the U.S. first, followed on by probate in the foreign country. So I think I'd say this. if at all possible, it's best to avoid foreign probate. And believe it or not, that's easier to do than one might think. And the simplest solution might be, if they're keeping the asset in the family, sell it or gift it during life to your children. And then you don't have the probate problem. Sell it for a note. The other idea, though, is that under certain rule changes, you're now allowed to have what we'd call an international will. And so I think it's critically important to talk with a local attorney for foreign assets. And I think there's substantive differences when the foreign asset is real estate and when it's a interest in a business. When it's an interest in a business, the treaties usually cover taxation and situs of that asset. Whereas if it's a hard asset like real estate, it's going to be situs in the foreign country. The long and the short of where I'm going is you'll need to involve foreign counsel to do it correctly. You may or may not be able to use a trust, which is now evolving. Most EU countries now do allow use of trusts after the adoption of the Hague Convention. So there is some opportunities to use trust, which we didn't mention it, but trust bypass probate. So again, the idea is to create interests and structures that bypass foreign probate. You can probate a U.S. will in a foreign country, but the first thing you'll have to do is go get a certified translation and then go to a notaire in the foreign country and have a ribbon and racks put on it. But there's a lot of work involved. And as I said, the best idea is to not have that issue. So if you're not keeping it in the family, sell it before you die. If you're keeping it in the family, gift it or sell it for a note, or use a trust structure.
And can I just jump in here, Juliette and Jonathan? What about multi-state probate issues as well? People could have real estate in multiple states or other assets. They need to be probated in multiple states. Can they avoid that through your suggestions as well?
Yeah. Yes, and it's the same.
No, let's hear Juliette first. Yep, Juliette.
It's the same, approach as Jonathan is mentioning. The point, ancillary administration can be very costly, and the whole point is trying to avoid probate to avoid the need to have to do ancillary administration in that other state. So as that's the whole point. Just trying to, if you can fund your trust, or it makes a lot of sense to do that before you die in order to avoid the need to do ancillary administration in another state. So it's the same.
Yeah, and the only thing I'd add to that is being careful with out-of-state real estate about putting them into LLCs or things, because Massachusetts isn't able to, under the state constitution, isn't able to tax out-of-state real estate. But I've seen some folks in the idea of sorting out probate, putting real estate that's out of state into a structure that then makes it taxable in Massachusetts. And while it's only 8% or more, it's not a huge tax. On large numbers, it's a pretty good number.
Which again is an unintended consequence of doing things without working with the team.
Yeah. And that's the other thing. Beware of gifting S-Corp shares following on the quirky assets.
Jeanette, next question.
What's the best way to hold life insurance?
Who wants to start with this one?
Sure, I'm happy to take it. So life insurance obviously has many benefits in addition to tax in the way that you can hold it. But obviously life insurance can protect your family from your premature death, can help to pay for college education, pay off a mortgage. And life insurance is not taxable for income tax purposes, but it is included in your estate. So the best way to hold life insurance is in an irrevocable life insurance trust. And the trust should be the original owner and beneficiary. And that way you remove the proceeds from your estate. If you own a policy and then you transfer it to the trust, then there's something called the 3-year rule that you have to outlive for 3 years in order for that to be removed from your estate. And also remember that the trust has to be the owner and the beneficiary in order for it to properly be in the estate, out of your estate. And in order to pay taxes, the trust, for example, could also provide a loan to your estate to pay for estate taxes. So from the perspective of how do you pay for estate taxes, life insurance can provide protection on that front as well.
So just to build on that a little bit, there are some complications, I think, as well when you're using life insurance to fund a buy-sell or cross-stock purchase agreement, or if you want to get life insurance out of your entity structure and into a trust or into the other ownership arrangements. So these are very tricky tax issues and should be well thought out and discussed with your professionals because making a misstep can be quite costly with life insurance.
Sure, this transfer for value rules and like you said, you don't want unintended tax consequences when using these vehicles.
Jeanette, we have just a few minutes left. Do we have a question or two that we have remaining?
We've, excuse me, we do have a few left, but try to get through it quickly. Many times a significant portion of people's wealth is tied up in their retirement. What's your advice for substantial assets in your retirement plan? Can you name a trust as a beneficiary?
I think we addressed that one, but
Okay.
so Jonathan, do you want to add to it at all?
Well, actually, I would just say that I think what people might have been thinking of is that historically the rules for retirement assets made it difficult to have a beneficiary designation to a trust. And when estates had large retirement assets and not a lot of outside assets other than that, it was problematic to utilize the GST exemption or tax structures effectively because of something called the conduit rule, which required payouts from the trusts unless it met certain requirements. And typically, due to the compressed tax brackets for trusts, it's not a very good place to accumulate ordinary income either. So where I'm coming to, though, is the 2017 Tax Act greatly simplified those rules. And now there's no longer a problem with designating a trust as a retirement designee from that. But again, I come back to if you have philanthropic issues or aspects of your estate plan, using those assets for charity is just what I call a no-brainer. And then the other one is typically families have some element of healthcare costs in their elder years. And given the fact that you still get a medical deduction for significant healthcare expenses, it may be a way to fine-tune the distributions out of the plan and avoid paying tax and effectively using pre-tax dollars for healthcare costs. So I think there's some use of that designation as well.
Juliette?
Sure, I just wanted to make a couple of points. One is just to remember that retirement plans, your IRA is not a probate asset, so your will does not control how that is disposed of. So you want to make sure that you review your beneficiary designations and that those are up to date. And also what Jonathan mentioned about the conduit trust. Before, you had to jump through hoops to make sure that your trust qualified as a designated beneficiary to be able to stretch the payment over the beneficiary's life expectancy. And now those rules changed, and because of them, you can actually accumulate money in a trust. And that could be beneficial. Many times clients were okay with their child receiving the minimum required distribution over the life expectancy, but they just didn't want the child to have access to the money. But with these conduit trusts, the money comes in and it goes out. And now after secure, the distribution period for just about everybody except your surviving spouse is a 10-year period. So that just means that you're pushing the money out to your child, and that may not be what your client wanted to do.
Yeah. Yeah. And I'd like to add one more thing to that. So if you have an estate plan that dealt with a beneficiary designation in trust prior to 2017, it's probably a good idea to dust that document out and wander back to your estate planning attorney.
I wanted to say we've now come to the end of the webinar, and Stephen, Juliette, and Jonathan, thank you so much for the conversation today. I think that what one takes away from it is how complicated estate planning is, but how critical it is to reconsider or establish your estate plan now. We did touch on the issue that you don't know when you may pass. None of us really do. But because of that, and because of the uncertainty now and the opportunities now is a very good time to reconsider your estate plan, to implement it, or to create one. Jeanette, I want to turn it back to you now.
I just want to thank all of our panelists again. We really appreciate all of your time. We did have a couple more questions here, and I will have our panelists reach out to you directly for your questions that were not answered. It will be recorded, so I will be sending that out in the next day or two. And I know Eric has another webinar coming up in October on captives. Eric, do you want to talk about that real quick?
Just quickly to say that captive insurance is both a business planning device. It can, a captive insurance company can address things such as the pandemic. If another one were to occur, it's an important vehicle, but it also can be used for estate planning. And we'll address that in October when we have that next webinar. Jonathan will be joining me and Abby Kruger from Licata Risk Advisors on that panel. But again, as to now, thank you so much to Juliette, Jonathan, and Stephen. Your wisdom is well appreciated always, both today and during the times we're dealing with clients' estate plans. So
thank you. And thank you to Bloom Shapiro for co-hosting this webinar today. Have a great day.
Very good. Thank you.
Bye now.
Bye for now.